Hi everyone, welcome to FTX and thanks for having me. I hope you can all hear me. Great, terrific. Hope everybody has had their morning breakfast and coffee and you're ready for this big download on FinTech. It's called the State of Union. I'll try and do justice to the title and share what our view at Sequoia Capital and my view is on how FinTech has evolved, how it is shaping the world and changing the way all of us interact with money. Um, So here we go. Just give me 1 second. Yep. Let's start with a little bit of a global picture before we dive into India. And before we dive into Fin, let's look at tech a little bit. It's a pretty standard slide, but I think it's important to take a step back and just see how technology has changed the way the business world works. This is a slide which shows how the top 10 companies by market cap have evolved. On the leftmost side, we have 2001, then 2011, 2021. I'm sure many of you have seen this before, but it's important to just notice how tech has taken the gigantic share of the top companies. 8 out of now top 10 companies are tech companies, which is not something we've seen ever before. As it happens, this number was higher a few months ago, and a few have fallen off in this recent changes in the public markets. Sorry, just give me 1 second. I'm facing some issue on my PowerPoint. Yep. Hope you can continue to see me. This is a different way of slicing this data. Here's the number of total companies which are above 1 billion, 10 billion, and $100 billion market cap. And you can see that the number of tech companies in this universe has continued to grow. Number of billion plus companies are now 15% tech, 20% for 10, it's 25 to 30% for 100 billion, but it's 100% for 1 trillion, which basically points to the fact that technology reduces friction, the challenges of scale, and that shows up in just how the winners in the technology world scale up as well. What this has led to is that every tech company in their respective market has amassed the largest disproportionate share of value. Look at Uber. Market cap is almost as much as other public passenger transportation companies. Facebook, which is now Meta, is almost 90% of all media companies. The same is true for Tesla in the auto industry, Netflix in the entertainment industry, of course, Amazon in the retail industry. Please note we've taken a conservative share of the retail part of Amazon and cut out the AWS value, but still very high. Airbnb in the hotel and resort industry, and DoorDash in the US restaurant industry, right? Each of these has taken disproportionate value of that industry. But there's one missing piece here, which is financial services. And the funny thing is, financial services is the largest market cap creating industry of all, even more so on net profit margins, right? So it's quite obvious that this is a trend that we as investors, and me particularly, given my interest in the fintech space, expect to pan out over the next few years, right? As it has always been, the juiciest markets have been the darling of disruption, and we expect the same happening in the financial services industry. Some of it has already panned out. If you look at it in the last 15 to 20 years, now more than 180 companies are valued above $1 billion. There's just a snapshot of which these companies are in North America, Europe, South America, Australia, and then, of course, our very own Asia, a large part of which is India. And it's not a surprise that in the financial services market, the tech companies have outperformed the financial services index, right? So this is just a graph where the gray line is the Dow Jones index, financials index. Then the light green line is Visa and MasterCard, which were the 1.0 of technology in financial services. And then the dark green and the blackish green line is PayPal and Square, and you can see how the newest technology companies have significantly outperformed the index. And it's for a very good reason. It's for a reason that the fintech companies have managed to garner a larger and larger portions of the users. You can see Cash App, Robinhood, Venmo, and their user bases have grown from anywhere between 2x to 6x in case of Robinhood in a matter of 3 years. And this, of course, has led to an obvious thing that these companies have provided better experience, better products, leading to higher engagement, higher TPV, and higher revenues coming from these customers, right? The interesting thing is, which I want to clarify, is that technology has always been something which has expanded the market. As we noticed, the tech companies have grown in market cap, but not at the expense of financial services industry. It's not that financial services industry has come down in market cap, it has underperformed. But essentially what it means is that the advent of technology in financial services has expanded the market, right? Because they are increasing reach, they're increasing access to new consumers, they are bringing in new use cases, and that is a positive change. That is what we call not being a zero-sum game. And that's what excites us, right? And that has led to this $1.5 trillion market cap creation in the fintech industry, which is exciting, which is very large. And there are a few logos here, and many of our own Indian tech companies have contributed to it. But let's put it in perspective. This 1.5 trillion is a very, very small sliver of the 16 trillion of overall market cap available in the financial services industry, right? Now you apply any basic CAGR of the 16 trillion going at 5% for next 9 years, going to 25, or maybe 10% and going to anywhere between 30 and 35. It's quite obvious that this 1.5 trillion number can grow anywhere between 5 to 10x by the time we land over in 2030. And that's what is really exciting for us and for me. But let's go back, right? The obvious question is that we are comparing apples to oranges. We are comparing these monoline payment company, deposits company, credit card company, and fintech to these behemoths, to these giants of JP Morgan, Goldman Sachs, Deutsche Bank on the western side, Kotak, HDFC, ICICI on the India side, right? But not really so. So let's dial back a little bit in history to see how the banks of today, the very much worshipped 50 to 200, $500 billion banks actually evolved, right? This is Kotak. Started in 1985, and it started as just a bill discounting company. That's all they did. They expanded to auto finance. As you can imagine, these were not the two most lucrative sectors at that time, but they found a white space in the financial services industry, delivered a phenomenal product, and started building out distribution. As that happened, they entered into investment banking. They further got into life insurance, and they finally became a commercial bank in 2003. At this point, from 1985 to 2003, almost 20 years, they added a total of $300 million of market cap. Fast forward 12 years more, they entered more segments. We mentioned general insurance here, but they of course did many others, including credit card, etc. Added another $17 billion of market cap. And fast forward 6 more years, they're now a $50 billion company, playing in all products, expanded distribution. So what is this? It's a monoline financial services business continuing to do a great job of increasing distribution, adding more and more products, increasing capital base to become a $50 billion conglomerate or a full-fledged financial services company, or a bank as we call it. So now let's go back to the fintech world. What's really happening? Now this is a bank on the left side, and I've laid out 5 key product segments for a bank: payments, lending, deposits, wealth, insurance, right? There are a few more, but these are 5 key ones. If you think about it, what is happening in today's world is that each of these fintech companies is going after a wedge in the larger financial services space. They're targeting one category, whether that be payments for Razorpay or Square or Cash App, or that be deposits for companies like Jupiter or Epify or Revolut, or it be insurance, right? But that's what they're doing. They're doing an outstanding job, a distinctive product delivery to their consumer base. And they're using 3 key pillars to do this. 1, low-cost disruption. Each of these companies does not have the legacy issues of very high costs, lots of people, lots of branches. They're able to start a nimble operation. And that allows them to pass on the benefits they have on this cost to their consumers. That, along with the fact that they again are starting a clean slate on the product, they can think about customer first way of building a product and deliver it versus worrying about the backend system or the core banking system or any other technology that legacy has provided them. And then lastly, they're able to use loads and loads of data to actually do very fine customer segmentation for targeting, for better underwriting, and finally, basically reaching out and giving access to many more consumers than traditional financial services was able to give. Let's go into each one of these, right? We talked about low cost disruption. These are examples of 4 companies, right, across bank accounts, credit card trading, and P2P. What have they done? They have brought down the cost of transaction for the consumer massively, but not because they don't want to make money. It's simply because they have managed to rethink the entire core of financial services to say, I don't need A, I don't need B, I don't need C. I just need what I need to deliver outperformance to my consumer. And every dollar, every rupee of benefit that I have, I'll pass on to my consumer. Which has allowed them to actually focus on a consumer segment, which was actually ignored by the traditional financial world for the longest time. Look at Chime. They went after the young, low-income group. Look at credit card for Nubank in Brazil. They went after this unsatisfied young audience, which didn't want to pay 100% plus of interest rate on cards. They were able to bring it down significantly. And the same is true for Robinhood, which was then followed by the incumbent Charles Schwab, and same is true for Cash App. The second piece, product. There's just a comparison of HSBC to Revolut, right? What consumers think of these 2 companies. Of course, HSBC is much larger in terms of market cap value, but Revolut, not having any baggage, has been able to provide a phenomenal customer experience, product that was never seen before, but was definitely needed by the customer to deliver this outperformance. Let's just absorb it for a second. This is a rating out of 5. It's 2.7 versus 4.8. And no surprises, these are 3 countries in which there was a survey done on what is the NPS with the financial services incumbent and the NPS with the challenger. And the results are quite self-explanatory, right? And then lastly, data. Data has always been a very key lever in financial services, right? But using this data intelligently, accessing this data inside a fintech company itself or a traditional bank itself is not easy. It needs your systems to be created in a way that are augmented in a way that they can use the data smartly. Your product needs to be nimble enough that can use this data and keep changing as it reaches customer A versus B versus C, instead of being a plain vanilla single line product. Insurance is a great industry, right? Where people said single line flat pricing versus Lemonade came and said, hey, no, let me use this data to actually give the benefit to consumers who deserve it versus letting certain consumer take the baggage for the rest of the world. What has this led to? This has led to many of these companies starting from one product, going deeper and deeper into multiple products, and financials, Cash App, and more classic examples, right? But the interesting thing is that it has not been constrained to only fintech-focused companies, right? Fintech is crossing the boundaries of being in this constrained, confined environment of financial services and becoming something which is important and core to every other industry, right? Look at software. The evolution of software was that the companies were pure software companies first, then they started integrating payments, and now they're doing everything else, right? Look at these examples: Coupa, Bill.com, Square, Shopify, Wix, Toast. All these are software first companies. They're nothing to do with fintech payments, but it allowed them to get closer to their consumer, have a better connect, sell better, deeper products, make more profits. Finally, that's what they're doing for their shareholders, right? And there's just some data for Shopify and Toast, which both of them started as software first companies. Shopify was obviously e-com storefront, Toast was software for restaurants. But a large share of their revenue now comes from fintech and payments. And by the way, the same is true for the 4 big companies we saw at the first page. Each of them are getting into financial services because it allows them to have a better and a closer relationship with their customer. Facebook, Amazon, Apple, Google, each of them are getting in this, both in India and probably even more outside India, right? Now let's come to India. What's happening here, right? No surprises. Just like everywhere else, financial services is the largest market cap contributor. 30% of Indian public market cap is in financial services, majority of which is in banks, right? But why is it? Whatever I'm saying, one should ask that, hey, it's very obvious. Everybody should try and disrupt the largest market cap industry, right? But it does not happen because of a few reasons. Because there's an industry which is guarded by very, very deep moats. Distribution. The banks that we see have done this for decades, right? They've reached us in every corner of the country using their branches, using their agent network. And thanks to them, we are all financially literate, right? Products, it has never been easy to create these complicated financial services products, which need so many, the customer needs to be satisfied, the capital provider needs to be satisfied, regulation, etc. And then in those lines, deep capital needs and regulatory moats. Look at ICICI Bank, right? They have $20 billion of equity and $12 billion of debt. It's not a joke. Amassing that amount of capital, it's a moat. Distribution, 5,000 branches, with 14,000 ATMs, lakhs of agents. And then finally products, right? An integrated product suite. That is why it has not been easy to disrupt this market cap. But that's changing now with technology, right? There's a survey of consumers done as to how would they like to interact with financial services, and 30% don't think branches are important anymore. Only 30%, 38% think they are important, right? This is a change we have never seen before, right? And in India in particular, that change is getting more and more pronounced because technology, data has provided access which was not available. Earlier, you wanted to reach somebody in Ghaziabad, where I'm from, you needed a branch. It needed money, it needed people, but today it doesn't. There are 750 million people in India who are on smartphone. These people are able to interact with financial services much more easily because the cost of data, cost of interaction has come down, right? So the distribution mode is weakened. It's getting further weakened because it was hard to deliver the service of the product to the consumer. The cost of a manual interaction was $3 to $8. Now it's 20 cents, right? Paper-based KYC was a few dollars, it's not 30 cents, right? Credit card was very expensive, UPI is not, right? Each of these is allowing the younger companies to reach their consumers in a more cost-efficient manner, which was again a moat for bank. If you had amassed these 100 million consumers spending few dollars per KYC, how does somebody else do it? But if it's 30 cents, sure, I will do it, right? The second mode, which is product. Again, the way the products are built is changing. It's coming in the digital world, and that's why we are seeing companies which started monoline, whether that be Paytm and PhonePe on payments, Pine Labs on offline POS, Razorpay and payment gateway. They've managed to then add more and more products and make their product suite richer, right? This is something that incumbents enjoyed. They were able to go to a consumer and say, hey, I have 15 products, be with me. Why do you want to be with 15 companies? And it made sense till now, when each of these companies is able to go and say, hey, I also have a lot of products, right? And it's not just about having a product, it's also about having a superior product, right? I've taken two examples here, but honestly, this slide can be a deck because they're innumerable, right? Look at Grow. They've created a phenomenal UI UX, a very intuitive one, reached out to the consumer that was their target segment, the younger upcoming consumers, lowered the transaction fees, and then started to expand the product suite. Same for Razorpay. Every business had to get online, but it was just very painful to get an integration. And Razorpay changed that by saying, hey, I'll make it happen very quickly so that you can focus on running your business instead of trying to figure out if my integration is done, and then expanded the product suite further to cover every base of their merchant, right? The third mode, capital, big mode, right? Imagine you were in 2020, you were trying to compete with a traditional financial services company. How do you do that, right? If you don't have money in your pocket, in your balance sheet, but that's changing. As it stands today, financial services or fintech is one of the largest industries funded by the venture capital industry. Actually, last year, if I'm not wrong, 20 to 25% of all dollars invested by private investors went into fintech. That's a big change. The companies of today have access to a level playing field in terms of capital, right? And that has gotten further pronounced as we see Indian tech companies go public, right? Because that was a big change on both equity and debt. You didn't, beyond a point, private equity will have its limited extent, right? But public markets are really deep. And secondly, being a financial services company means you need access to debt. And companies like Policy Bazaar, Paytm now going public will have that, which again makes the level playing field when they're competing with the incumbents in the financial services world. right? And then lastly, but the most important mode, regulations, and for very good reasons, to be frank, right? Financial services is a very complicated industry. You're interacting with consumers, you're managing their money, you have to be responsible. So you have to gain the trust, the credibility slowly. But the regulations, both across the world and India, are showing that they're very supportive of the change. They're supportive of companies that will lower the cost of transaction, bring more and more consumers into the formal economy, into the digital economy, as long as these companies are able to justify and demonstrate that they will act fairly and they will act credibly, they will generate trust, they will have high governance. The regulations are becoming more and more supportive, and we are seeing the impact of it. All of us, I mean, I think this chart is quite overdone, because I think every fifth tweet is about UPI volumes, but it is still important, right? This is what regulation can do. This is the impact of regulation and how it's again giving tailwinds to the tech companies and the fintech companies, right? Now, we talked about banks. Take a second to just absorb these. I've put 6 companies out here, and I've put a few pillars of a bank. And see how what we think of as just a monoline, a payments company or an insurance company or a broking company, is actually expanding across the different verticals of the bank, right? They're able to become a full suite provider of financial products to their consumers. They're able to give a legitimate option, a credible option to the customer to have full life cycle management with these companies, right? But again, please, I want to emphasize that this is not a zero-sum game. This is about increasing the pie. Yeah, so the point I was trying to make is that let's remember that this is not a zero-sum game, right? Finally, this is all about increasing access, bringing more consumers into the entire loop of financial ecosystem, and increasing the interaction, the products they work with, and increasing the size of the pie. So I do not think that any of these companies is going to gain only at the expense of the current incumbents, but I think both worlds can win together. And frankly, it's going to be the only way any of these companies can win, because you will need to collaborate, because the incumbents have a vast knowledge base that the new age companies will need, and the new age companies have an advantage on the new age products that banks can benefit from, right? How do we see this panning out is this, right? If you look at the traditional world, summarizing, you had a regulator, then you had the banks, which were the capital sources. They were also the originators of financial products and reached the consumer. How it's changing is that this huge pool of new age fintech challengers have inserted themselves into this value chain. They have become the companies which are interacting with the consumer, offering products, building distribution. And the way I see it is that they're going to keep going backward integrating. They'll keep getting more capital as they prove they can distribute products profitably and serve their consumers. And as they do that over many years, establish the trust, the credibility, they're going to get on the right side of regulators. Regulators will realize that they can be a part of this ecosystem and benefit the ecosystem. And that's when we'll have a very different world. And if you remember the slide I showed, which was 1.5 trillion, 16 trillion, there's no question as to why that 1.5 keeps increasing. Why what we see today as a monoline business and not really comparable to the incumbents and these giants is actually just the beginning, and the beginning of how it actually started for the traditional world as well, right? So what it means for India today, $750 billion market cap. We see it continuing to grow, get to 2.5 trillion by 2030, right? Now, this is anybody's guess, but my guess is 20% out of that is an opportunity that is very easily targetable by the Indian fintech industry. $500 billion. I think if we put all the fintech of India together, we are probably close to $50 billion. So that's the opportunity we have, 10 times of where we are in next 9 years, right? That is what is exciting. That's why we at Sequoia Capital India are partners with many fintech companies in India, right? And Sequoia Capital has invested deeply globally as well across companies like Stripe, Klarna, Robinhood. In India, of course, we are very proud shareholders and Sequoia Capital is proud shareholders in Razorpay, Grow, Pine Labs, and many others. Thank you. I'll pause there and happy to answer any questions if you guys have.
All right, Ishaan, thank you very much. Once again, I hope you can hear me. Please, I know you have a very wide portfolio, must be quite busy as a person, but if you could just reply to all the business pitches I've sent you, I feel like we can collab on something big in the future.
Right away.
Thank you, Ishaan. This is a verbal contact. It's legally binding. But everybody in the chat, can we have a round of applause for Ishaan? Thank you very much for setting the stage for all the talks that are about to follow for the next 2 days. I think there's a lot of optimism in general. So everyone, let's thank Ishaan for his time, and then we can move on to the next session. Ishaan, I hope you'll stay with us to watch the rest of the conferences.
Of course I will, just like all the previous years. Thank you for having me.
Cheers, absolutely. Thank you, Ishaan.
Thank you.
All right, our next session is about the future of fintech. Now, whether you are a business or you are a consumer or you are a time traveling immortal being, what can you expect in the coming year? What are some emerging trends? So, joining us for the next panel, which is on the future of fintech, are Sudipta Roy, the group head of ICICI Bank, TR Ramachandran, the group country manager for Visa, Ari Sarkar, co-president, Asia Pacific MasterCard, Shinjini Kumar, co-founder of Salt, and Amitabh Tiwari, the Chief Innovation Officer at Razorpay. So I will see you just a bit in the next session. See you over there. Bye-bye.